Hey guys, this is John Bacaron with Family First Life Elite, VP of Elite Syndicate. I got here Yoel, Aynalem.
What's up, guys?
Future star in the making, writing agent and learning more about advanced markets. So what we're going to cover today is the Advanced IUL Express by Mutual of Omaha. So initially, the first training that we did, we just went over the easy solve. So this time, what we're going to do now is we're going to go over the non-easy solve, which is where we can overfund the policy, we can play around with it. Just remember, when you're doing an application, you have to submit a signed illustration. So you want to create the illustration prior to finishing the app, or even if you're there with the client, you can learn how to do it. So we're going to go through it step by step. Okay. So first and foremost, to create.
And you want to maybe teach them how to get to this page from the original screen,
right?
Because you do have to set up an account, right?
Right. So we are at a page right now. If you guys see my screen, we're on winflexweb.com. This is how you create an illustration for most IULs available out there. Okay, specifically for Mutual of Omaha, Index Universal Life. So if you guys look at my screen, I do have other carriers that is affiliated with FFL. You want to get these contracted with FFL AMS. The more carriers you have, the more access you have. So I do have Global Atlantic, American National, Mutual of Omaha, National Life Group, North American, and I just got recently contracted with FNG. So I know I'm going to cover an advanced topic, but to simplify it for brand new agents, please utilize fflams.com. Once you go in and create an account, you'll have an Athena access. You'll have an Ask a Specialist to use an IUL and annuities. Use them. Okay, so Bridget will help you out with the annuities along with Lauren. And then Kim is the director for the IULs. She'll be able to create illustrations for you. Now we're going to teach you how to do it on your own, but try not to play around with it because Kim is going to be the best to do so, because all you have to do on the Ask a Specialist is to list out the client situation, their age, their health, and what their needs are, whether they want an accumulation product or whether they want a death benefit product. Kim can look through all of our portfolio carriers and suggest the best solution for you. Okay, so I'm only going to cover a Mutual of Omaha IUL Express. Key distinctions on this: most IULs require 100,000 minimum face amount. What's great about Mutual of Omaha, it's simplified issue. We can cover anybody that's 60 and under, between $25,000 up to $300,000. Okay, what's great about that is that you can overfund a $25,000 policy. More importantly, we can get this issued within 2 to 3 days compared to a fully underwritten IUL that requires a physical exam. Okay, so we're going to start off. You want to create your account with winflexweb.com. Okay, once you create your account, you register, you would then add your carriers. Okay, so that's how you'll get this. Typically, it takes about a day to add the carriers and get approved from them. Certain carriers require your agent number to be added on to be able to be used. Okay, Mutual of Omaha does not. So you can create immediately, ask, request carrier Mutual of Omaha, and you'll be good to go. Okay, so next, let me start from the beginning, actually. This is how it'll be when you get contracted or you get set up, okay? You would then start a new case, click Mutual of Omaha, click Index Universal Life Express, and create a client, okay? In this illustration, while waiting on my computer, we're going to use Yoel, and we're going to be able to create a illustration for him, okay? Aynealem. Okay, birthday?
9/20/1994.
1994. Okay, we're going to use, there's only two options compared to other fully underwritten IULs. So if you're using a fully underwritten, you can actually get better rates because they can have a standard, preferred, premier, or in other cases like NLG, standard, select, preferred, elite. Okay, so in this instance, because it's a simplified issue, it's either a smoker or a non-smoker rate. Okay, now we pick the state, California. First part, we're looking at solve for. So earlier, the first video that we just did easy solve. There's actually a drop down in here for premium solve, face solve, or no solve. Okay, so what that means is you are now tinkering on how to create the best solution for him. So you kind of got to know what you're doing. So what scenario would you like to go through?
I wanna overfund it.
Okay.
I want to participate as much as possible.
Okay, and then you have a budget in mind, right?
$60.
$60. So if we have a budget in mind, we want to do then a face solve. Okay. If we have a face amount in mind, then we got to do a premium solve. Okay. So we're going to click on face solve. And then since you want to over budget, it's going to come down to the face solve option. Do you want to solve for cash value? You want to solve for a minimum premium, or do you want to do a minimum face and maximum funded premium? So this is where we're going to learn this.
Maximum funded, correct?
Okay, right. Now you have an option on your premium account amount that you want to put. You said $60 or $50?
$60.
$60.
I'm feeling crazy.
Feeling good. Okay, so now all we've done is 60. We're gonna cover it forever. Okay, so you're gonna pay for this. You can also choose when to pay. We're gonna do max. You can also play around with this and choose when to stop making payments. Do you want to leave that alone, or do you want to keep it at?
So what's the distinction?
So the distinction means you're paying now until the rest of your life.
Okay.
I could also play around and say you're gonna pay this until a certain age. At age, if I click it, you're 27 until your end of life, or I can say you're paying this only till age 65.
Okay, and then that would mean you only pay for that
$60 until 65.
Probably the face amount would go down, right?
No, you will have enough cash value to build it up. Okay, so we are overfunding this until you're age 65. Typically at 66 to retirement age, you don't pay anything anymore. You can start withdrawing cash value into it. Because the idea is overfunding it is to pay more coverage, to pay more into the cash value so you can withdraw from it. Because you're not looking for the death benefit, right? Right. So now, just in case you do die, the death benefit is there for you. But you're not hoping to die. You're hoping to live a long time, compound the interest growth, and then borrow from it as a tax-free retirement. So that's the purpose of the IUL by overfunding.
So I would probably want the 65 if I wanted to retire at 65.
Unless you want to retire at 70 or earlier, you could do whatever you want. But longer years...
65, I think.
Correct.
So the difference with the max is I would just keep funding it until, for the death benefit to be as big as possible?
Yep. Death benefit and the cash value is as big as possible.
Got it. Yeah, let's do 65.
Okay, so in this scenario, we are telling the illustration that from 27, 37, 47, 57, and then all the way to 65, you're doing about 38 years of compounding interest to this. Okay, but understand, the more you can put in the target premium, the better it is. Okay, so since we're doing the minimum face amount, it's going to try to lower the death benefit as low as it can possibly do without going into MEC. MEC is called the modified endowment contract. There's a limitation on how much life insurance you can have and overfunding it. Because if you overfund it, back in the days, you can actually just get a $1,000 life insurance and overfund it $1,000 a month. But now that became an investment, so that's what an MEC is, a modified endowment contract.
And then taxes
the limitations, correct. Okay, so we want to avoid that. Now we can also choose here on the next tab. It's called the disbursement. You can choose when to start withdrawing as an automated premium loan, which is going to be your tax-free retirement. Okay, so you can do a disbursement, solve for max level disbursement. Okay, it's going to be a loan or withdrawal.
I don't do loans, man. I'm gonna do withdrawal, man.
All right, you can do a withdrawal. Basis to loan. I don't know. It's turning red. Just pick the one. Pick the one you can work. Okay, you see how it's doing red?
Red means you can't do it.
Yeah. So it's dummy proof. If it's red, you're doing something wrong. Okay. So we're gonna do max level. We're gonna pick. You don't want to start withdrawing immediately at the start age, right? You said you want to start at 66. So now we're gonna start it. First one, so this is where it gets confusing. From now until 65, you're funding it. Okay, so we're not solving for anything. So we're gonna say 0 here. Okay. But from 66 to max, you don't really have to fund it all the way till you pass away till 120. I say from 66, let's say to 86.
So at 66, or when I start pulling money out, what happened to the face amount? I'm slowly pulling from it?
You're slowly pulling from the death benefit.
Got it.
Okay. Your next question is going to make sense into the next tab. Okay. Next tab is just the strategies. Okay. The difference between an IUL Express compared to other IULs, there will be more strategies. And this one is a fixed account 1 year point to point. Okay. Another index, there's multiple indexes in other IULs. Just extra info. You want to do policy options. So this is going to go into your next question. There's a cash value accumulation and there's a death benefit in the IUL. If you pick level where we are on the screen, that means the death benefit stays the same. You can build as much cash value as you want, but if you die, the death benefit just pays the same one. Typically, the best solution is to put an increasing death benefit to where now the cash value and the death benefit adds on top. It costs a little bit more life insurance, but as your cash value builds up, in case you were not there to pull it out, it still pays on top of your death benefit. Okay. Now, if you did level, it costs less because the cost basis of the life insurance doesn't change as much compared to the increasing. So but if you're overfunding it, you want to have it increasing.
Increasing?
Yeah.
Okay. Well, I was going to say, if I want to use it as a form of retirement,
yeah,
wouldn't I want it to be level? Because I'd be going more, because I don't really care about the death benefit as much.
Yes, but there's a point where you can get cheated that way, because let's say before you retire at 66 and you start taking it out, you had a death benefit of 100,000, but you had a cash value of 300. That cash value is kept by the company. Just as an example, because you're choosing a level death benefit, you're not allowing the additional cash value to pay on top.
Got it.
Okay.
But I don't care about my fit. No, I'm just kidding.
You can, but then you just let the company keep it.
No, heck no.
Right?
Oh, wait, time out. So if it's a level product and then there's a cash accumulation within that product,
if it's level, you only get the death benefit.
The death benefit. Oh, yeah. No,
increasing allows you to pass away to have the death benefit plus the cash value on top.
Oh, okay.
Okay.
Interesting.
So remember, we always want to click on prevent MEC to prevent the modified endowment contract. So now it's an increasing. This is very important when you're choosing your solve for the premiums, minimum, your disbursements, your solve for earlier. So we chose the premium amount, right? Make sure under the policy options that you did choose BSP, which is the monthly premium instead of annual. That throws off the illustration, because if you're fronting the annual premium right away, that means the company already has the money. It can build accumulations faster. So annual premiums are actually a little bit better than mode of monthly. Okay, that's pretty much it. With the IUL Express, on the Easy Solve, the riders are all built in, except there is actually an accidental death benefit riders you can choose to add if you want to play around with it. Okay, so you can see that, and then the accidental death benefit rider can go up to like 200,000 depending on the face amount. So you'll see that on the right side. You see that for between 26 to 60, you can actually add up to 250,000. But the riders do not build cash value. It's an extra cost of life insurance.
Got it.
Okay, you had a question?
No, that's it.
Okay, so this is an option if you're playing around with it on the non-easy solve. So you can actually add accidental riders and child riders. But the built-in ones are the accelerated living benefits, chronic illness, critical illness, and terminal illness. I do want to point out that the critical illness is not available in California. Outside of California, most of the states are allowed for that. Okay?
So my uncle, I think he may want this to be like a supplementary to like a long-term care.
Okay. Do you want me to elaborate on this?
Yeah, a little bit.
Okay. So this is not long-term care. Okay, it's not a long-term care rider. It's kind of like long-term care that it can be used for services. Okay, but it's an accelerated benefit rider. What that means is that you're accelerating the death benefit payout while living, just like a terminal illness rider. So first off, terminal illness rider, if your doctor diagnosed you less than 1 year to live, you have 12 months to live, you're accelerating the death benefit. It's like taking out the death payment while alive. Okay.
You can only take out 80%, correct?
50 to 80%. Certain policies are up to 100. So you want to look at your policy. But I typically, the best way I learned from Jack Yu, the way he explains it is, think of it like when you get in a car accident, you have an adjuster. Depending on how severe the accident is, tells you how much your payout is. Same thing to this. Okay. So maybe 50 to 80, but I just tell them you get an accelerated death benefit.
And the chronic, they determine how much you get to pull out as well?
So the chronic, compared to critical, chronic illness is a definition of not performing 2 of your 6 daily living activities, meaning you're bathing, you're dressing, you need a caretaker to take care of you, feed you, give you medicine, get you in and out of bed, get you in and out of the chair, get you in and out of the shower. If you can't perform 2 out of the 6, you need help. That's where the chronic illness comes in. You're able to pull out a portion of your money. Critical illness is if you had a critical illness, like a brain surgery, major organ transplant, heart attack, stroke, loss of hearing or sight. So it was a critical thing. You're basically needing help. And ideally, these living benefits are there to support your life insurance because you're no longer going to be able to work. You might need long-term care. So this is what I mean by that. It's not long-term care, but since you kind of need help, you're able to borrow or pull out from accelerated death benefit out of your life insurance for use of that. Okay, but understand it's not considered long-term care because the long-term care insurance would be to pay that whole thing off using a separate insurance for it.
Yeah.
Okay, which requires certain certifications and policies and other different products to use. Okay, so it's an added living benefit. It's an added feature. It doesn't cost anything on the IUL Express. That's the benefit of it. Okay, so how I would sell this is I just explained that it's a multifaceted benefit. Takes care of you when you're living. Gives you cash value just in case you get hurt, you get sick too big, or you get terminally ill, you can pull out a little bit of life insurance. And just in case you die, there's still the death benefit to it. Okay. Lastly, we're doing the report. Make sure you guys complete your profile.
And I have a question. So,
sure.
A whole life product that accumulates cash value, correct?
Correct.
If you're unable to make those payments, it doesn't pull from the cash value to make your premium payments, right? But the IUL kind of does. So say hypothetically you couldn't make your IUL payments, wouldn't the cash value support that?
So
is that a rider you can put on or something?
That's called an APL, automatic loan premium, or ALP. Automatic provision loan is actually what APL stands for. When you guys do a whole life policy, there's always that question. Is APL, do you want to click this or yes or no? That's a feature even on a whole life where it'll automatically borrow the life insurance premiums from the cash value to pay the policy and keep it going.
Got it.
Other policies will just be frozen without the cash value not being used and lapsed.
Got it.
Okay, so following message, the distribution cash accumulation based on age option will be ignored when solved for max level, blah, blah, blah. That's fine. So here's the benefit, okay? Once we create it, you click on the PDF. You guys will see this. We open it up. Yeah, this is the signatures needed on page 24 typically. Okay, so let me just scroll over real quick. Here's the page 24. You will need your signature along with the client's and dated. Okay, but now let's go into the features. Okay, so I'm going to go more in detail now. I had heard extra explanation was needed for this for certain agents that want to learn more. Okay, so it's the 39-page thing, right? Do you need to explain this to all the features to your client? No, just the main benefit. But if you want to, it'll go into it. So we got an increasing death benefit. So the initial death benefit on this is $37,559, and this is as funded as we can. Now, is it max funded? Probably not, because you're only putting $60. Yeah. Okay, but still not a bad thing, and you have all these riders in there. So you can expand on it. You can scroll down what the riders will be. Going back to the percentages, let me search it. Here are the living benefit. Okay. 2 of the 6 daily living activities for 90 consecutive days. That's the chronic illness. Okay, terminal illness is 12 months. Okay, but they're not saying percentages. Access a portion of your death benefit early. That's all it said. It's just like an adjuster, right? You just wait until what that is. All right, so this is just more in detail about the indexing, the market, base assumptions, the year. They have to fully legally show you this and what happened in the year in the S&P 500. And, we are in 2022. If you guys have been paying attention to the market's been tanking. So the benefit of this with the IUL specifically is that if the market tanks, you have 0 of a level, which is a floor. So your cash value does not dip. Okay. So 0 sometimes will be your hero. Okay. So let's scroll down. The most important part is the illustrations. Okay. I'm trying to lower this, but what happened? Okay. If you can see, as I mentioned earlier, there is a guarantee that if the market tanks year per year for the next 20, 30 years, this is going to be guaranteed. Okay. In an IUL with Mutual of Omaha Express, your guarantee is either 20 years first or until you hit the age 80, whichever comes first. Okay, so if you're 27, you have guarantees from 37 to 47. Okay, after that, there is no guarantees. Okay, so your guarantees is 0%, which is your floor. A midpoint illustration shown here is 2.935, and the current illustration at non-guarantee is 5.87. So far, so good?
Yep.
As you notice, your death benefit is increasing. It covers you now all the way till 93 years, till your age 120. So not to go too much in details, but when you explain this to the client, okay, this is your cash value. Let me explain here. Here's your age. Here's your premium outlay, $60. Multiplied by 12, that's $720 a year. This is your payment. Okay. You're paying. You have 47. You have guarantees. You have an increasing death benefit. Okay. Now, as the market not make money, because you have an increasing overfunded cash value, even your guarantees continue to grow. Okay. So this is a good sign. This is a well-funded policy. Even if, assuming you don't gain any interest on the guarantees, you're actually covered all the way to age 80.
Wow.
Okay. You don't lose money into this because you're starting so young. You have 37, 38 years to compound it. But we only explained a little bit of the guaranteed. We really just want to talk about more on the non-guarantees, because this is really what's going to happen the most. Okay, we started off at 37,000, right? 559. With your cash value, it starts to accumulate, and it keeps building and building and building. Okay, so we're going to go into age 65 because that's what we wanted to look at, right? You're now age 65, right here. Assuming things went well, you're going to have $72,000 of death benefit. And that $72,000, because we chose an increasing death benefit, will get you $109,578. Okay? So if you do the quick math, take 720 multiplied by 37 years. What's that? Let me use a calculator real quick. 37 times 720. You would have paid in $26,640 into this. But because you had a compounding interest of 5.87, you gained $72,000 in cash value as a cash value on top of the death benefit. Now it's 109. So if you pass away, it pays out 109. If you want to start cashing out, you start taking money out, you can get up to 72,000. Now, if you leave it, you can choose to take the accumulation or leave it growing. It'll keep growing for you, even if you don't make any more payments. So starting at 67, look, because 66 was the last time, come that year, it still continues to grow for you. Okay.
Wow.
So you tell the client on the far right, sir, you go to 100, not touching this, at 100, you'll have 311,000. Plus your death benefit, now you'll have 350,000.
Now, so hypothetically, for like self-employed people, is this something that's good for like a retirement or like something similar, like an IUL?
Yes, because you got to understand, for somebody that's self-employed, what do they have as a 401k, IRA, or anything through their work? It's whatever they funded. So this is a better solution to fund. We have a lot of products that's like a key person insurance, where it's an IUL. It pays and covers the company in case they die because they're a key person. But in case they don't die, they can actually use this as a retirement fund. So we have a lot of those things. That's where the FFL AMS comes in. We're able to help out.
Yeah, I think I need something as a self-employed person. Something like this. Because a lot of people, they switch jobs, they might not roll over their 401k. It's a new age right now, the entrepreneurial, job to job. And not
just that, but,
Starbucks worker age.
As the market changes, pensions are going away. Certain big companies, mainly unionized companies, have those 401ks and pension plans set up. There was something that I'm looking for, is the loan values that maybe didn't pop up. Maybe that was the error, because I was looking for where you can start taking out cash. It's not showing in here.
That's the this right, the middle, like the cash value.
No, so this is the accumulation and the surrender. Let me explain this too. You see how it's different for the first 10 years? Okay, so when you start an IUL, they have fees if you cancel too early.
Got it.
Okay. So your accumulation value is different to your surrender value. If you canceled and you cash surrender, meaning you canceled the policy, they tack on fees that if you canceled on the first year, you're not going to get any cash value back.
Got it.
Second year, you had 1133, they took about a good chunk, 700. So they have a strong surrender period. Okay, it's typically 10 years. So come the 10th year, look, your cash value is 73. If you canceled, you're only getting docked $300. Okay, $200 here, $100 here. Okay, and then come come the 15th year, on the 15th year, you get everything matching now.
And talk a little bit about how this is kind of a hybrid between a whole life and a term, in the sense of like your cost of insurance goes up throughout the years. That's why you want to overfund it. Like, kind of talk a little bit about that.
Yeah, so it's a permanent plan. An IUL is a permanent plan, but it's actually built in like a 1-year term policy. So this is, your premium splits up in 3 ways, and this is why you want to overfund it. First off, there's the janitorial fees, the upkeep, okay? So this is just like a $10 policy fee, okay? So that's taken for administrative costs by the insurance carrier. Second then is your cost of insurance. The younger you are, the cost of your insurance based on the death benefit is less. So the way we set this up and created this, we said minimum face amount, because if we lower the face amount, we lower the cost of your insurance, and now we can overfund and max fund the policy, okay? But let's, for example, had a 50-year-old that only wanted to overfund a $100,000 policy for $100. That cost of insurance could be $95, and you're only putting $5 into the cash value.
And it's going up.
It's gonna go up for 2 seconds, and then it's gonna go back down because your cost of insurance.
The cost of insurance is going up.
Right. So because every year your cost of insurance does go up. So why you want to overfund it? Because your cost of insurance of incremental increase is being outpaced by the compounding interest of the cash value. So this is where IULs can actually go upside down if you underfund it, because as the insurance cost goes up, and you're paying the same premium and you're not increasing your premium, less money goes into the cash value. You'll hit a tipping point or the plateau where your cost of insurance and the premium payment is exactly matching, that zero money goes into the cash value. So come the next year, your cost of insurance went up a little bit, you're paying the same premium, you're short, it's being borrowed from the cash value to maintain the policy. So it's meant to do that at the long end, okay? So,
but not
certain
you don't
parts,
want to accidentally do that.
Yes, you don't want to accidentally do it. You're okay doing that when you stop making payments.
Yeah.
Okay, you'll hit a plateau, but in your situation, your plateau continues to grow because your death benefit is outpacing the cash value along with the compounding. Let me use the example of the middle part. Okay, so we'll actually see this in the middle part. If the interest rate is smaller, which is the non-guaranteed middle area road at 2.75 compared to 5.87, it doesn't actually last you forever. Okay, we're looking at age 40, 67. You're growing still, 36, 37, 277. Okay. Now we're going to age 70. You're at 39,000. Okay. We're going to now 77. We're still at 41,428, and in 1 year we went from 41 to 529. We only gained $100. Okay, but when we went to age 78, wait a minute, what's happening? We went from 41,529, now we went to 41,513. This is your plateau. If your interest rate is only staying at 2.75, that means your cost of insurance has gone to the point where it's the same premium of the $60 you're paying. Your next year, it costs a little bit higher, and you're short a little bit. Now it's borrowing from the cash value. So now you see, we went from 513, 360, and now it's 049. Now it starts to drastically go from $20, $30 to $100 to $300. Now you're dropping 41 to 40 to 39. And as you age, your cost of insurance, because you're older, goes higher. Now it's going from the hundreds to 1,000, 37 to 35 to 33 to 31. Okay, and as it goes, and you get older and older, your cost of insurance goes up. Now it's 28 to 24 to 20 to 15 to 9 to 2, and you're out of life insurance at 94. Okay.
And what do they base the percentage off of? Is it the past 100 years, or like what's the age? Because they have the guarantee, they have the 2.75, and they have the 5 point.
No, nothing is guaranteed. The guarantee is 0%. The non-alternate is 2.75.
Yeah, what do they base the percentages on? Just previous past performance?
Yeah, so that's where the first few pages that we went through, just how the market is, and if it was a low market or a high market, they play around with that. Okay, so they actually go, so here's an example. Okay, minimum 3.75, average 5.87, maximum 7.3. The historical 25-year average credited rates.
Got it.
So they do use that S&P 500, the 1 year point to point. So they average those down from 2002 to 2021. They took the highest years, they took the lowest years.
Got it.
And that's how they play around with the numbers. But every year is changing. So the illustration is meant for this illustration. That's assuming it's the same steady pace for 2.75. That's assuming it's the same steady pace of 5.87. So it's very important when you're playing with IULs, a client does receive an annual statement per year to see where their money's growing. Okay, and you want to pay attention to that because sometimes when you start noticing the premiums going down, you'll start getting panicky in a sense. But as long as you're overfunding it, you should be fine. Okay, do you have any other questions?
No, I think I got it. That's good.
The last part I wanted to show you is the amount of withdrawals, but I guess the illustration kind of blanked out on us. Maybe that's what that yellow is. Let me try again. Solve for, okay. We're supposed to take disbursements from 66 to 80. Oh, I'm sorry, I didn't do it. So you see how I said we're not taking any money here? I added this, but I forgot to take this part out. And I'm gonna do the solve max from those 20 years. Okay, this is what I did.
What does that mean?
So this is where I'm telling the company or the illustration from 66 retirement age that you're going to be able to take out some incremental borrowing of the withdrawal of your cash value to maintain you till 86. Okay, we're going to click calculate. It's submitting, it's creating that again. So that's why I was like, where's the cash value accumulation or withdrawal? It's missing because I forgot it. So this is what I mean. Even though I know what I'm doing and I'm teaching you on this, it takes one little misclick. It gets confusing. So sometimes I want to just expand on, using FFL AMS. You got to know what you're looking for. You got to know where you went wrong, what happened.
What does AMS do for you? Would they run an illustration for you?
Yeah.
So they would run this and then send you the documentation and say, hey, present this?
They'll email you the exact illustration we just went over.
Oh, wow.
Now, if you need to explain, you need to have a one-on-one conversation. You could do that with Kim as well.
So if I wanted to get one for myself, I could talk to her.
Yeah.
Or for myself. Oh, okay, that's nice. And that's
you can tell her
resource for FFL
it's
agents?
a free resource for all FFL agents. You just tell them how much I want to pay in. This is my height, weight, health. I got no issues. I'm willing and comfortable to pay $1,000 a month or $500 a month. She'll find you the best solution. Now, are there higher, better accumulation products out there? That is why we have a lot of different IUL products. Yes, the answer is yes. There's a higher accumulation, but are there a lot of simplified issue like Mutual of Omaha with the lower death benefit of $25,000? No. Okay. NLG is close to it. NLG is minimum $50,000, and there's semi-simplified issue up to $2 million too.
And how do you is the contracting process with these carriers different because it's advanced market or?
Yes. Okay. So the current situation right now with FFL HCMS is for the regular life products. The FFL AMS is done through Navi, which is the head of contracting for FFL AMS. We actually with FFL have two subdivisions, the main life and then the AMS side.
So who do I get in contact to get contracted with those?
You will always want to contact your contracting liaison. In our agency, we go through Joanne, who will then contact Navi, who will send you an invite through your Sure LC, and then you're off and running.
Yeah, I need to do that.
Yeah.
So what's going on with your?
It's still calculating. Maybe
Man, it's crunching some numbers, man.
It's crunching a lot of numbers. I clicked it a while back, but maybe I did something. Something popped up earlier that it errored. Maybe it could have been that. Let me try again. I know it errored earlier. I knew it. Yeah, something popped up when we did the error. Let me start again. Okay, so Index Universe
This is a
Live.
review, intentional review.
Thanks. Well, I'm just gonna put your name. 920.
1994.
94. Okay. So solve for. We're going again. Premium solve. Face solve actually minimum. Okay, you're paying $60. We're asking for the disbursements. Okay, disbursement amount. We're going age. We're saying 0 from now to 65, and then we're adding 66 to 86 max funded, and then 87 to that. We're good. Okay, standard loan, disbursement, good. Okay, this is the illustration of the strategies again. Okay, we're choosing increasing BSB for monthly premium. Okay, no riders, info, good. I knew as soon as I clicked submit, something popped up in the middle. And I think that's what it was. It got stuck.
You put the disbursement amount in time?
Yeah,
Okay.
the max part, yeah.
That works. Seems pretty straightforward.
Yes, but here's where the complications comes in. When you try to do a different product, a different company, each interface is different. So you're looking for the disbursements. Yeah.
Oh,
they tailor it to how they do it.
Oh.
Yeah. I guess a little bit more confusing. There's like guideline premium test, cash accumulation premium test, and I'm like, man, let me just ask him. All right, so we're back here. It popped up. Okay, so same thing, 37,559. Now you'll see on the illustration your cash value disbursements. Okay, so now you see this at 28, as we mentioned, to 66, we're not taking any money, right? Now at 67, check this out. With your cash value accumulation, you can safely take out $57.29 a year. Okay. So if you're retiring and you got your Social Security, you can take this out yearly or monthly, but you can have an additional $482.59 added to your Social Security safely.
At what age?
Starting at 67, how we illustrated it.
And safely implies that it won't go.
That your death benefit won't cash out on you.
Got it.
Okay, so your accumulation can still grow, but understand. Check this out. So we did it till 86, right? You can still take it out, but starting at 87, we've almost drained the cash value.
Got it.
Okay, so if you look at the surrender values is this is your accumulation, but this is how much you were withdrawing from it. So you're left with 505. Okay, which is okay.
Yeah, considering you still have your death benefit.
Yeah, but if you look at it now, you're at 87.
You're back to where you started.
You're back to where you started, but at 88, because we did take out the premiums and you're no longer making payments on it, your death benefit is just going down. But the cool part is your death benefit at 100, it's actually, your cost of insurance goes so low that even though you had 1923, you'll actually start going up again.
Wait, your
without
cost
paying.
Of insurance goes down?
Almost zero, yeah.
As to, at what age?
At 100.
Why?
Check. Certain limits for the insurance company, basically they endow, they shouldn't charge you anymore.
Because you're sold?
Yeah. So if you look at it, check it out. 1932 at 100, at 101 you went back to 1970. So even though you no longer made payments on this, you tapped out, you gotten $5,791 per year for 22 years. So if you take that 5,791 multiplied by 20 years, right, 66 to 80 years, you've taken out 115,820. Remember, you did 720 times 37 years.
$60 a month.
27,000.
I paid that much.
So you've almost tripled your investment into it, and you had retirement-free, untaxed money. Okay, as long as you were borrowing from it, and it still will last you till age 120.
Withdrawing, you mean? Or is
Same
it
thing.
Same thing. Okay.
Yeah, withdrawing and
I got
borrowing.
those two terms, like it means borrowing still means taking out.
Yeah,
you don't have to pay it back.
You can choose to pay it back or never pay it back. It just removes out of your cash value.
Oh, got it. That's why it's called borrowing, because you're borrowing it from yourself, kind of.
Yeah, it's also kind of like systematic withdrawals because you're taking it out per year. So it's a mix and match. All right, guys, that's pretty much it that we have for you guys. I know it's very complicated in advance. Do this when you're more comfortable. You know how to play around with IULs. It's not an easy thing. It's not a hard thing. It just takes a lot of time to learn. And, if you want to spend time on it, do it. But I would recommend you, number one advice that I'm giving you guys, learn this on your non-income producing time. Okay, you want to learn this at 11 p.m. at night? Feel free to do so. But you don't want to learn this in the middle of the day when you could be dialing, making phone calls, and booking appointments and selling on the phone or in the field. Okay, so focus on this easy process. Focus on the clients that you can make a sale and get simplified issue and paid on it. But these helps out because you will run into some clients, 27, 30, 35, 40, that doesn't have any insurance, doesn't have any retirement plans. They do have disposable income they want to fund into. That's going to be safe money market. This is one of the better solutions. We do have stocks, we do have crypto and other things, but it's directly exposed to the market. This one has a guaranteed floor of 0. So I hope this helps. Thank you guys for listening in, and have a good one.
Peace out, guys.